Many people are feeling uncertain about their investments. Maybe you're wondering if you're making mistakes that could cost you money that you can't afford to lose. You're not alone. In this video, we are going to cover the 7 biggest mistakes investors are making right now, and more importantly, how you can avoid them. Trust me, avoiding these traps could save you thousands or even millions over the course of your investment journey. Mistake number 1. Worrying that every market dip is a crash. Let's face it, market dips are stressful. When stocks begin to tumble, it's easy to panic and assume the worst. But here's the reality. Market pullbacks are completely normal. Think about it. Markets are like mountain climbers. They climb high, but they also need breaks to regain energy. A dip isn't always the start of a crash. It's often a sign that the market is recalibrating. For example, this year, we have seen several pullbacks in April, July, and August. Many investors hit the panic button, but these dips didn't lead to crashes. They were part of the market's natural rhythm. So the next time you see a decline, remember, don't panic, stay the course. Mistake number 2, avoiding the market because it's up. Now this is a big one, avoiding the market because it's been performing well. After seeing the market hit all-time highs, some investors think it's too late to get in, or worse, they sell off their investments to lock in profits. But history shows us that bull markets often last for years, and all-time highs are a common part of that process. Take a look at this. Over the last decade, the market has hit dozens of all-time highs and then kept climbing. If you sat out every time the market hit a new high, you've missed out on substantial gains. So remember, don't fear the highs. They're often signs of strength, not weakness. Mistake number 3, focusing too much on a few stocks. It's tempting to put all your money into the latest hot stock or tech giant. After all, who wouldn't want to own the next Tesla or Amazon? But concentrating your portfolio in just a handful of stocks is incredibly risky. For example, recent market gains have been driven by a small group of companies, leaving many portfolios overly reliant on those stocks. If one of them falters, it could spell trouble for your overall return. Instead, focus on diversification. Think of your portfolio like a well-balanced meal. You need a mix of proteins, carbs, and veggies to stay healthy. Similarly, a mix of asset classes and industries can help you weather market ups and downs. Mistake number 4, holding too much in short-term investments. Short-term investments like CDs and treasury bills can feel safe, especially when interest rates are high. But here's the problem. They really outpace inflation over the long term. If you're investing for the future, whether it's for retirement or building generational wealth, stocks have historically delivered much higher returns than short-term options. And keep in mind, if interest rates drop, the returns on these investments will decrease, leaving you with reinvestment risk. Long-term growth often requires taking some calculated risk with stocks and bonds. Mistake number 5, ignoring taxes in investment decisions. Taxes can eat into your returns more than you might think. Here's one common mistake: trading too frequently in taxable accounts. Every time you sell a stock for a profit, you trigger a taxable event. And if you sell within a year, you're likely paying higher short-term capital gains taxes. To avoid this, consider tax-efficient strategies like holding investments for the long term, using tax advantage accounts like IRAs, or investing in tax-efficient funds. Remember, it's not just about what you earn, it's about what you keep. Mistake number 6, letting the perfect be the enemy of the good. How many times have you delayed investing because you were waiting for the perfect opportunity? The truth is, perfection doesn't exist in investing. Even the best investors don't have a crystal ball. The key is to focus on progress over perfection. If you've created a solid plan that aligns with your goals, don't let fear or indecision hold you back. As the saying goes, the best time to invest was yesterday. The second best time is today. Mistake number 7, obsessing over headlines and politics. Let's be honest, there's always something worrying in the news, whether it's the election, global conflicts, or economic downturns. But here's the thing, Markets are driven by fundamentals, not fear. Focus on data like corporate earnings, stock valuation, and consumer spending. These are the indicators that truly impact the market, not the latest headlines. Investing is a journey, and mistakes are part of that process. What matters most is learning and growing. By avoiding these 7 common traps, you'll set yourself up for long-term success. If you found this video helpful, let me know in the comments. And don't forget to like, subscribe, and share to help others avoid these mistakes. Check out my video on the biggest dividend mistakes to avoid at all costs. Until next time, stay financially savvy. I'll see you in the next video.